So we cannot go ahead and invest in a company purely based on the fact that it may appear to be undervalued. We also need to assess the health of a business. Now, in order to ensure that the company is healthy, we are going to look at the balance sheet. Now, the same way you now know how to find the income statement under item 8, you can go ahead and find the balance sheet. Alternatively, you can press Ctrl and F on your keyboard, type in the word balance sheet, and press enter until you arrive at the statement. So, the balance sheet is split into a few sections. You have the assets, the liabilities, and the equity. Assets represent economic resources controlled by the entity, which are expected to provide economic benefits to the entity, such as land or buildings or equipment. All these assets can provide a benefit to the entity if utilized correctly. Do you agree that land, buildings, and equipment can help a company to produce products which it can sell to earn money? We should agree, okay? Liabilities are obligations that are expected to result in an outflow of economic resources in order to settle the obligations. Loans from a bank, for example, require a company to make payments to a bank in order to settle the loan. Lastly, we have equity. Equity is quite simply the residual of the business. What is left over if I go ahead and sell off my assets and pay off all my liabilities? So, how can we ensure that a company does not go bankrupt? Debt is something that many companies have. Debt can also be called loans or borrowings. These loans or borrowings have contractual obligations that involve the payment of money from a company to the people who lend the company money. These payments consist of interest and the original capital portion. As a value investor, quite simply, you don't want to be worried about debt. It is very hard for a company to go bankrupt if it does not have debt. Therefore, to deal with this problem, there are a few simple rules that one needs to have and adhere to in order to avoid investing in a company that could possibly go bankrupt, as it is unable to pay its loans and borrowings. In order to ensure we don't invest in these companies, we want our investments to have a debt to equity ratio which is preferably less than 0.3. This is according to Peter Lynch. However, due to the low interest rate levels in the US, this amount could be bumped up to 0.5 in my opinion. Now the ratio. Debt is the sum of the current portion of your long-term borrowings plus the non-current portion of the long-term borrowings, operating lease liabilities, and other long-term liabilities. Equity is quite simply the residual left over in the business after we have sold off all our assets and paid off all our liabilities, i.e. your assets less your liabilities. It is a mouthful, I know. Let me explain. So, debt can be found on the balance sheet under current and non-current liabilities. If you look at the bottom half of the statement over there, you will see a few of these items. A little technical, but current liabilities are those liabilities due in 12 months, and non-current liabilities are those liabilities due longer than 12 months, beyond 12 months. The easiest way to calculate debt is to take the current portion of the long-term borrowings under current liabilities, it's that first red arrow over there, and add it to the long-term debt, operating leases, and other long-term liabilities under non-current liabilities. Those are those bottom three red arrows. In order to calculate equity, just use the total equity figure on the balance sheet. This has been highlighted in green. The equity figure represents the residual interest in the assets of the entity after deducting all liabilities. This means that if the companies were to sell off everything it owns, i.e. all the assets, and pay off everyone it owes money to, i.e. all the liabilities, you get equity. Ensuring the debt to equity ratio is less than 0.3, according to Peter Lynch, ensures that the company has not taken on too much debt and is in a safe position to continue operations in the foreseeable future without the stress of bankruptcy. This ratio can be quite easily found on the internet in addition to this calculation we just performed. Just search for the name of the company and type debt to equity after that. In the case of Microsoft, if you add up all the amounts which have the red arrows, you get the debt, and the green arrow gives you the equity. This is sometimes called total equity, just for the record. It can either be called total stockholders equity or total equity. And if I take the debt amount and divide it by the equity amount, we get the debt to equity ratio. As we can see, Microsoft does not have a debt to equity ratio below 0.3. Next, we want the cash in the bank to exceed the current portion of the long-term debt under current liabilities. Now, the current portion of long-term debt under current liabilities, remember, represents the amount of money that the business has to repay its lenders and borrowers in the next 12 months. We want to ensure that the company has enough cash to do this. You can find the cash in the bank under the current assets section. This has been highlighted in red under the name cash and cash equivalents. If we look in the 2019 year, we can see here that the cash and cash equivalents is greater than the current portion of long-term debt. So that makes Microsoft a slightly safer investment. Lastly, we want to ensure that the company is generating a sufficient amount of money in order to pay the interest. The interest cover ratio helps us determine this. In order to calculate the interest cover ratio, we need operating income and interest expense. To do this, we are going to go to the income statement. In the income statement for Microsoft, let me know if you can find the interest expense amount. I will give you 5 seconds. You can't, right? It is not like that for all companies, but in this case you cannot find the amount. So in order to find the interest expense, we will press Ctrl and F on our keyboard at the same time and type in the word interest expense. Keep pressing enter until you come to a table like the one at the bottom of this slide. As you can see, this table breaks down the line item other income, net, in the income statement. If we take the figure for operating income and interest expense, we can now calculate the interest cover ratio. It tells us how many times the business is able to cover the interest payment every year. The higher the figure, the better. It shows that the business is safer. Ideally, you want this ratio to be at a minimum greater than 10. In the case of Microsoft, we can see that it is. So that makes Microsoft a safer investment. I have included an article for this lecture which contains a summary of some of the most important ratios for financial analysis. It tells you how to calculate the ratio and explains its importance. Although I covered the crucial ratios in this section, I believe learning some of these ratios will greatly benefit you as a beginner value investor.